Hello and welcome to another episode of the weekly financial update from RTS Financial Planning. As always, I'm your host, Carl Roberts, Chartered Financial Planner. I hope you're all doing well and surviving lockdown too. Not too much longer to go now. Obviously, big news this week was the news of a vaccine, which fingers crossed is going to be able to get us out of this COVID misery. As you can imagine, stock markets were very pleased with the news, and stock markets around the world have had a really good week on the back of it. In particular, if you look at the charts, you'll see the UK has significantly outperformed the likes of the US market. And there's a few reasons for that, which I'm just going to delve into now, just to explain why. So, firstly, the UK stock market is made up heavily of financial companies. So we're talking banks here mainly, and also energy companies, mining companies, that sort of thing. And these are the sectors that have been particularly hit hard by COVID. So if you think of the banks, interest rates have gone down to record lows, and it's very hard for banks to make significant profits when interest rates are so low. So the fact that a vaccine's come along has significantly improved their prospects. Obviously, they're hoping now that we can get back to things as normal as possible pretty quickly. And there may even be interest rate rises over time. So very positive news for the likes of the banks. If we flip round and look at the US stock market, that is made up predominantly of tech companies. And obviously the tech companies have benefited hugely from COVID. If you think of the likes of Zoom, we're all doing Zoom meetings because we're all working from home now. Netflix, we're using Netflix more, watching more programs in our downtime. And Amazon, the likes of Amazon, we're doing a lot more online shopping rather than going out into the high street as the shops are shut. So these companies have done really well out of COVID, record sales, record growth. And the fact that a vaccine's come along and hopefully will send everything back to normal is sort of putting a bit of a dampener on their kind of growth targets now, because people might now go out and spend more in the shops if we're able to. We might get out and do more things rather than sit at home and watch Netflix. We might go into the office more now rather than do all the Zoom meetings. So all those kind of share prices have taken a bit of a tumble, and that's obviously affected the US market. So looking at some of the other sectors, airlines, obviously they were decimated when COVID sort of first struck. Their share price has really fallen significantly, as no one's really flying anymore. Again, a significant boost to their share price on the announcement of the vaccine. So obviously it's early days with that vaccine announcement. Obviously the stock markets are quite confident on it, the fact they've risen so much. But a word of caution, we don't know the full facts. We don't know how successful the vaccine is going to be. There's still a long way ahead to go to anything like normal. And particularly when it comes to your investments, it's interesting when you see the headlines, sort of stock price surges, you need to look underneath to see actually, what's going to be impacted by the headlines. So you may have seen stock markets rise significantly, but if you've been holding tech company shares, you actually might find your portfolios have fallen. So really interesting to look underneath the headlines and look at what affects your actual portfolio. And another good reason why to be diversified. So sticking with the sort of COVID support schemes, if you're looking to move soon or help your children out with their purchasing their first home, you're probably aware there's a stamp duty holiday on at the moment. This was announced by the Chancellor to help support the house moving process during COVID. So there's a stamp duty holiday until the end of March next year, 31st March next year. And this basically means that houses purchased under £500,000 will pay no stamp duty at all, which is a significant boost to your money when purchasing a house. But what we're finding is that you do need to act quickly. So even though the deadline is till March next year, we've been told that there's significant delays in the mortgage approval process, just because there's such a surge in demand. Banks and things are just not able to process mortgage applications through quickly enough. And obviously they're trying to check them more now with what's been going on with the unstable job market. Also, conveyancing process is really slow at the moment as well, because when solicitors and things are coming to do their searches, different councils are very slow at the moment because they've got less staff working on this particular area because they may have been redeployed to help out with the COVID response. So big delays at the moment on the house moving process. So if you are looking to move or buy a house, you do need to act quickly to not miss that deadline. And just to mention that the stamp duty holiday does also apply for buy-to-let investors. So you will still have to pay the 3% surcharge, on any properties that you buy, but you do still benefit from some form of stamp duty holiday up to 500,000. So that's interesting. Again, sticking with the COVID support, the furlough scheme, you probably know that that has been extended until March as well. But with the job market still uncertain, you may be worried about what's going to happen to your job. Redundancy could be on the agenda. And if you're coming up to retirement, maybe redundancy now is not such a bad thing. It could mean your last chance for a big payout before you retire. So I just wanted to recap on the tax situation with redundancy payouts. So if you receive a redundancy payment, up to £30,000 of that redundancy payment will be tax-free. Anything paid above that will be subject to income tax at your normal rates. It will be added on top of your other income. So, for example, if you're paid £50,000 redundancy, £30,000 will be tax-free, £20,000 will be added to your income. So if you're a higher rate taxpayer, you may pay 40% tax on the £20,000 redundancy payment. So just a recap there. And finally, I just wanted to touch on an area that's relatively new to the investment world, and that's fractional ownership. So we've written an article on this week, which is now live on the rtsfinancialplanning.co.uk website. If you just go on there, news and views, you'll find the article on fractional ownership. And this is an interesting concept. So I'm just going to tell you a little story, go back to my youth in the 90s. I was quite into the 90s supercars. My top three favourite cars were the Ferrari F40, the Jaguar XJ220 and the Lamborghini Diablo. I had the Matchbox little cars, I had the posters on the walls, I had the Top Trumps pack. I was really into them, really loved them. And what was really interesting recently, the motor car program Top Gear did an episode on these 90s sports cars and picked those three exact cars to do a little segment on. So it was brilliant to watch that again. And if you want to see it, it's on the BBC iPlayer. It's a really good episode. And obviously when you're young, you dream of owning one, but as you get older, you sort of realise just how expensive they are and you think, that's probably not going to happen. Well, with fractional ownership, that dream could turn into reality. Because with fractional ownership, basically, it applies to probably mainly expensive assets. So think of sports cars, think of yachts, aeroplanes, expensive artwork. Rather than purchasing the whole item yourself, there's platforms that have now started that allow many investors to purchase individual pieces of these items. So if we go back to the supercar, if we go back to the Ferrari, Ferrari owners, if they ever come to sell their cars, it's very difficult to find a buyer that's got that sort of cash swashing around who wants to buy that type of car. But if they're willing to sell it to a platform, a fractional ownership platform, you may find that there's 100 willing buyers that will all pay £1,000 for a small share in a Ferrari. So you own a small piece of a Ferrari. So why would you want to do this kind of thing? Well, there's a couple of reasons. Obviously, it is classed as an investment. So you would be looking to make money out of it. But also there's a fun element to it, isn't there? If you're really into your cars and you like Ferraris, for example, this is a way of actually owning a piece of one. These companies will usually let you go and see it, take photos in it, and you can go on track days and potentially use it. So there's that fun element to it, but also you can make money out of it. And there's two ways you make money out of an investment like this. One is through an increase in price over time. So the rarer the car, it tends to hold its value, may have increased in value over time. So there's a sort of a price growth you get. But also there's the ability to earn income from these types of assets. And that income comes from the form of renting out the car to film companies so that it can be used on films or in music videos or in promotional events. These companies will pay you for the use of your car. So a couple of ways to make money there. So obviously, it's not something that you should stake your whole retirement portfolio on in this type of thing. But if you've got spare cash, all your kind of core retirement portfolio is taken care of, and you're willing to take the risk, and you're interested in this kind of area, this might be something that appeals to you. Like with any investment, there's risks attached, and the biggest risk for this type of investment would be what we call liquidity risk. So the ability to get your money back out as and when you want it. You won't have that functionality here, or it's unlikely you will. If you go onto one of these fractional ownership platforms, you purchase a share of a Ferrari, if at some point you want to get your money back out of that Ferrari, you've got to find a buyer willing to take on your share. Now, the more popular the asset, you may find that these platforms have a secondary market where there's loads of other shareholders are willing to take your share off you, but there might not be. It's not like the main stock market where there's millions of people trading every day. So you may find that you've invested into one of these shares into asset, and actually it takes a long time for you able to get your money out. So do be aware of that kind of thing. But as I say, we've written an article. There's much more information in the article that is available on our website. I'll put links into the YouTube comment section. So that's about it for this week. I did just want to mention that, as always, if you could please subscribe to the YouTube channel, which will give you notifications on when we release new videos and things. And one of the big reasons why I say that today is that whilst this video that we're doing now is recorded, we are looking to go live in the next few weeks using YouTube Live. So YouTube does give you the functionality to go live, which means we'll stream straight to you at an associated time. And if you're subscribed, you'll get notification of that. So yeah, looking into that. It's going to be interesting. I'll have to definitely do a lot more prep and practice to make sure we get it nice and slick. But as I say, yeah, hoping to go live. So if you're subscribed, you'll get notification. Also, we have a new video that's about to drop in the next week, which is all about cashing in your pensions, how to do it, the flexibility that you've now got, be able to take money out of your pensions. Again, if you're subscribed, you'll get a notification of when that video is then live. So I hope you found it useful today. As always, please leave comments in the section. If you've got any questions or any interesting feedback, please leave a comment. But until next time, take care.